All right, class, welcome. Today, we're going to conduct a really deep dive into a vital accounting concept, one that's absolutely crucial for any of you who want to be future business leaders, managers, or analysts. We're going to tackle a pretty fundamental question. How do we account for assets that we don't just use over time, but that we literally consume as part of our core business? This is where the numbers on a spreadsheet meet the real physical world in a very direct way. Let's get into it. Now, in your studies so far, you've gotten very familiar with what we call plant assets. Think of a factory machine, a delivery truck, or the computers in an office. We get it. These assets wear out over time as we use them to generate revenue. But on the other side of this slide, we have a totally different kind of beast, natural resources. This could be a coal mine, an oil well, or, as we're going to analyze today, a granite quarry. With these assets, the value isn't just diminishing through wear and tear. The asset itself is being physically removed, consumed, and sold. And that is a fundamental distinction that, you guessed it, requires a totally unique accounting approach. So, before we explore this new concept, it is absolutely essential that we solidify our foundation with a principle you all should know very well: depreciation. I promise you, understanding the logic of depreciation is the bedrock, pun intended given our example, for grasping how we handle the consumption of natural resources. Remember the matching principle? It is one of the cornerstones of accrual accounting, and depreciation is its perfect application. Look, when a company buys a truck for, say, $50,000, it would be a complete misrepresentation of reality to recognize that entire $50,000 as an expense in the year you bought it, right? Doing so would make that year's profitability look terrible. Instead, under GAAP, we capitalize the truck as a long-term asset on the balance sheet, and then we systematically allocate its cost to depreciation expense, over on the income statement, across its estimated useful life. This way, we properly match the expense of using the truck to the revenues it helps generate over several years. It just makes sense. And this brings us right to the heart of our challenge today. What happens when the asset isn't just helping you make a product, but when the asset is the product? I mean, every single ton of granite you pull out of a quarry, every barrel of oil pumped from a well physically reduces the amount of that asset you have left. This poses a totally different kind of accounting problem, and it requires its own unique solution. And that solution brings us to the main event for our discussion today, the concept of depletion. This is the specific accounting term we use when we're allocating the cost of these natural, consumable resources. Okay, let's really pull this definition apart for a second. You'll notice it sounds very, very similar to depreciation. It's all about cost allocation over a productive life. But the critical difference, and this is key, lies in what's happening to the asset. With depletion, we are physically consuming the resource, and, crucially, we are converting it into inventory. That barrel of oil or that ton of granite undergoes a transformation on our books. It literally moves from being part of a long-term asset, the oil well or the quarry on the balance sheet, to being a part of current assets as inventory, now ready to be sold. And this quote from the textbook just hits the nail on the head. It brilliantly illustrates the core logic. Think about it. The initial purchase price of that quarry represents the total value of everything you can eventually pull out of it. It stands to reason, then, that every unit you extract, every single ton of coal, every cubic foot of gas, represents a tiny piece of that initial cost. The accounting process of depletion is simply how we systematically move that cost from the balance sheet over to the income statement as the resource is extracted and ultimately sold. Theory is essential, of course, but accounting really comes to life through practical application. So let's make this tangible. Let's walk through a case study to see exactly how depletion works in practice, and maybe more importantly, how it informs critical business decisions. So let's meet Bedrock Mining Corp. So I want you to imagine you're the management accountant at Bedrock. The company has just made a massive $2 million investment. Your very first task, and it's a crucial one, is to figure out the cost embedded in every single ton of granite sitting in that ground. To do that, you need two key pieces of information. One, the total cost of the asset. That's our $2 million purchase price. And two, a reliable geological estimate of the total units you can possibly extract. In this case, 100,000 tons. Now, what's really great here is how simple and intuitive the underlying logic is. We need to find a cost per unit, which, in this context, we call the depletion rate. The calculation is a really straightforward two-step process. You just take the total capitalized cost of the natural resource and you divide it by the total estimated units you expect to get out of it. It's just a simple ratio, but it is incredibly powerful.
And the result for bedrock mining is a depletion rate of $20 per ton. I want you all to lock this number in your minds. Circle it in your notes. Highlight it. This $20 figure is our foundational unit cost. It represents the portion of that quarry's $2 million purchase price that we can attribute to every single ton of granite. This number is the key that is going to unlock all of our expense calculations moving forward.
Okay, so the business is now operational. In its first year, Bedrock's team extracts and, importantly, sells 5,000 tons of granite. Now, as the accountant, your job is to translate this physical, operational activity into the language of finance. Let's see how our $20 per ton depletion rate impacts the company's financial statements for year one. The calculation here is just beautifully logical. We take the number of units that were extracted and sold during the period, that's 5,000 tons, and we multiply that by our predetermined depletion rate of $20 per ton. This gives us a total depletion expense for the year of $100,000. This $100,000 figure will appear on the income statement, and it will directly reduce the company's reported profit and ultimately its net income. So this is the crucial point. Who cares? Why does this $100,000 accounting entry, which isn't even a cash payment, matter for making real-world business decisions? This, right here, is where accounting transcends just being bookkeeping and becomes an absolutely indispensable management tool. This chart illustrates the impact perfectly. Let's just say Bedrock sold that granite and generated revenue of $500,000. Without accounting for depletion, a manager might mistakenly look at that and think their profit is exceptionally high. But by properly expensing the cost of the resource we've consumed, we see a much, much truer picture of our actual profitability. That $100,000 depletion expense gives us a way more accurate understanding of our real performance. And this accurate picture is absolutely vital for decision-making. Imagine you're in a strategy meeting at Bedrock. You might say something like, okay, team, look at the numbers. We know our depletion cost is $20 per ton. Our labor, equipment, and transport, that adds another $45 per ton. That means our total cost is $65 per ton. Now, if we're selling it to contractors for $80 per ton, our margin is $15. Is that enough? Is that margin sufficient to justify expanding operations? Or do we need to think about raising our prices? You see, this is how these numbers actually drive strategy. You have to know your true costs to price effectively, to evaluate if a project is even viable, and to accurately forecast your tax liabilities. Now, to really deepen our understanding, let's look at some common areas where students, and honestly, even professionals, can get tripped up when they're dealing with depletion. Avoiding these pitfalls is absolutely key to performing sound financial analysis. Let's break these down carefully. First, and this is a big one, depletion is a non-cash charge. The cash, all $2 million of it, went out the door when Bedrock bought the quarry. The $100,000 expense on the income statement is simply an allocation of that past expenditure. It does not represent cash leaving the company in year one. Next, that 100,000-ton figure is an estimate. What if a new geological survey in year two reveals there's actually 120,000 tons left? A good accountant doesn't panic. They simply revise the depletion calculation for all future periods based on this new, better information. Accounting requires professional judgment. Finally, and this is a subtle but critical application of the matching principle, you expense the resource when it's sold, not just when it's extracted. So if Bedrock extracted 5,000 tons but only sold 4,000, the depletion expense would be $80,000. That's 4,000 tons times $20. The cost of that unsold 1,000 tons, $20,000, would just sit on the balance sheet as inventory until it's actually sold. And this leaves us with a final and much broader thought. The accounting mechanic we've discussed today has profound strategic implications. You see, the very act of booking a depletion expense is a financial acknowledgement that a finite resource is being used up permanently. So, as a future business leader, how does this reality shape your long-term planning? Does it create a strategic imperative to invest in new technologies, maybe explore more sustainable practices, or to plan for the day when the quarry is empty and that asset's value is literally zero? That's the powerful intersection where accounting principles meet corporate strategy and the creation of long-term value.